Real estate may yield more wealth than any other industry, yet people remain skeptical about joining the fray. Moreover, most people think that they require to start with some capital, but that's not always the case. The one magic power you do require is to be able to find the cash. And we're usually not talking much to open up escrow. And if you know what you're doing, you can earn cash in real estate even if you're just starting. Remember, there's no quick way to earn money or get wealthy in real estate, but you can grow wealth slowly and consistently by investing correctly. You're probably aware that there are several ways to accumulate wealth, but real estate is one of the most lucrative. Having said that, making money in real estate or profitable investing needs proper guidance, techniques, and determination. Note that while investing in the industry is a proven and proper method of making money, it comes with inherent dangers like any other business. Most new investors don't know where or how to invest in real estate. Here are the best 5 ways to grow your wealth in real estate. Number 5. Real Estate Investment Trust, REITs. A real estate investment trust is excellent for investors who want portfolio exposure to real estate without a traditional real estate transaction. REITs allows one to invest in real estate without physical real estate. Usually compared to mutual funds, they're companies that own commercial real estates like retail spaces, apartments, office buildings, and hotels. REITs tend to give high dividends, making them a typical retirement investment. Investors who don't require or want the typical income can automatically reinvest those dividends to grow their investment further. So, how exactly are REITs created? REITs are created when a corporation or trust uses investors' money to buy and operate income properties. They get purchased and sold on the major exchanges like any other stock. A corporation must pay out 90% of its taxable profits in dividends to keep its REIT status. By doing this, REITs avoids paying corporate income tax. In contrast, a typical company would be taxed on its profits and then decide whether to distribute its after-tax profits as dividends. Like other dividend-paying stocks, REITs are a solid investment for stock market investors who desire regular income. In comparison to different real estate investment types, REITs allow investors entry into non-residential assets, such as malls or office buildings, that are generally not feasible for individual investors to buy directly. Above all, REITs are highly liquid because they are exchange-traded trusts. In other words, you won't need a real estate agent and a title transfer to assist you to cash out your investment. REITs are a more formalized version of a real estate investment group. Are REITs a worthy investment? They can be, yet they can also be varied and complex. As aforementioned, some trade on an exchange like a stock, others aren't publicly traded. The type of REIT you buy can be a significant factor in the amount of risk you're taking because non-traded REITs are hardly sold and might be hard to value. As a result, new investors should generally stick to publicly traded REITs, which you can buy through brokerage firms. For that, you should have a brokerage account. If you don't already own one, opening one takes less than 15 minutes, and most companies require no initial investments, though the REIT itself will likely have an investment minimum. Number 4. Rental property purchase. One of the most common ways of making cash in real estate is to leverage long-term buy-and-hold residential rentals. People will always require a place to live, which implies getting involved with rental properties. You have to do the proper amount of due diligence to source your property by keeping 3 principles in mind. Location, location, location. Yes, you've heard it before, but location is everything when it comes to real estate. This doesn't apply to an increased asset over time, but also to your ability to rent that property to a long-term tenant quickly. Search for an excellent location when you're considering long-term residential rentals. That's more crucial than the current state of the property itself. In fact, rundown homes in fantastic locations are one of the best investments. Rental property purchases entails a more traditional approach to earning income in a real estate market. It involves buying a property with some cash on hand to make a down payment and then holding that property for the long term. You can quickly get that property for a very low or even no down payment, depending on your personal situation. That's especially true if this is a pre-existing income-producing property. If there's positive cash flow in a residential rental, it'd be a good investment. Still, most probably won't find that too easily unless the current owner is unloading for personal reasons. For instance, a divorce or other need to liquidate that property necessitates having some money on hand. Number 3. Opting for the 1031 exchange. As a real estate investor, you can use this tax code called 1031 exchange to sell an investment real estate and use the profit to purchase a new one of equal or more excellent value. In this way, you can evade paying taxes until the next property is sold or opt for another 1031 exchange. You must pay taxes for your capital gains when you choose to sell your property. With the assistance of Section 1031 of the Internal Revenue Code, you're allowed to postpone paying taxes when you reinvest those profits in another property. IRS considers that you are exchanging your old property for another real estate property. Number 2. Farmland. As the name suggests, farmland investing indicates you're investing in some form related to the production of crops. At the end of the day, the land is real estate, which is categorized as real estate investing. Yet, instead of investing in buildings or housings or retail space, you're investing in farmland. There are approximately 911 million acres of farmland in the United States, according to the USDA. You might be shocked to discover that over half of that farmland is rented, meaning the farmer is paying the owner of that land for the rights to use it. Billionaires such as Bill Gates have been scooping up farmlands for years. In fact, non-operator landlords own most of the rented farmland. These are landowners that have no direct association with the actual farming. Operator landlords own the land and are actively involved in farming activities. The USDA found that 283 million acres worth, or 30% of all U.S. farmland, is owned by these non-operator landlords. These groups want to capitalize on the investment opportunity involved with farmland without getting their hands dirty. Only 20% of the rented farmland is owned by operator landlords who actually work the farms themselves. Every day, more people are finding out about the investment opportunity within owning farmland, but not necessarily getting involved with the farming activities. New farmland investing platforms are popping up, potentially offering you the chance to get in on the action. Number 1. Timberland. For the last 100 years, it's been close to impossible not to make money in timberland. The only trick you had to know was to hold whatever type you purchased for a long time. The trees grew, increasing the volume of valuable timber. However, you could cut some trees at the top of the stumpage cycle if you needed cash. And finally, the dirt itself, usually known as bare land, appreciated as our population increased. There are various ways to invest in timberland. The technique selected depends on the investor's total capital to be invested, the amount of liquidity desired, and the amount of participation in managing the timberlands the investor wants. A way to invest in timberland that provides high liquidity doesn't need a significant amount of capital to be invested and doesn't require active timberland management is to purchase shares of timber-related publicly traded stock. Two examples are timber ETFs, exchange-traded funds, and timber REITs, real estate investment trusts. The difference between the two is when investing in a timber REIT, only one timber company's stock is being bought. On the other hand, timber ETFs are similar to mutual funds and comprise stocks from different timber companies. Another timberland investment strategy is the outright purchase of timberland. This method proves low liquidity but a higher level of control. Pension funds, endowments, and charitable foundations with vast amounts of capital to invest and don't have the desire or experience to manage the timberlands often hire timber investment management organizations, TIMO, to buy and manage their timberlands. TIMOs typically offer two types of products: individual accounts and commingled funds. Individual accounts give more control of the invested capital but require a much higher capital investment. The minimum capital requirements of most TIMOs for a personal account are around $30 million. A commingled fund consists of capital from multiple investors and therefore has a lower capital entry requirement. The amount of control over the investment is less with a commingled fund. However, these funds usually offer greater portfolio diversity, which results in less risk to the investor. And with that said, those are the 5 ways to grow wealth in real estate. Let us know your thoughts in the comments section. We hope you enjoyed our video, and be sure to give us a thumbs up and share it. And also, subscribe to our channel and ring the notification to get notified when we upload new and interesting content. And until next time, goodbye.